What is good, YouTube? It's your boy Sam, and I am back with another video. Unfortunately, I recorded a video before this, and I was really spitting some knowledge, but I realized my mic wasn't on. So here I am, having to record the video again. It's not going to be as good as the first one, but try to make sure I get all my points across. So make sure you subscribe so you don't miss the next video. You like, you comment, and you share this video so we can grow our community. Okay, so in this video we will be discussing open interest. Now you might be asking, what exactly is open interest? Right, it's a simple question. I'm going to give you a simple answer, but it gets a lot more complex than that. Okay, now if you follow this journey, you will see later on we will discuss open interest on a higher complexity and with more advanced examples, but we're going to keep it pretty basic for now. When it comes to trading stocks, buying and selling shares, something to consider that a new trader may not know or understand is open interest, right? Where the open interests are. Now, what exactly is open interest? So in previous videos, we discussed the different type of orders you can place. You have market orders, which is where you buy or sell a share at the market price, and whatever it executes that based off of when you click that sell button or buy button, that's going to be your market price, and it's going to fill you in basically where that order is at. Right? An open interest is basically when there are limit orders in place to buy or sell a particular stock at a certain price. We're going to use company A, for example. Let's say you wanted to trade company A, and company A is trading at $100 a share, give or take. But let's say you want that discounted price. You want to make sure you capitalize off of that small dip based off of the volatile fluctuations, and you say, you know what? It's at $100. It's touching $101. It's touching $99. It's touching $102. It's touching $98. It's touching back $100. And you want to make sure you execute at the lower end of that price. You can put in an order, let's say at $98, like a limit order at $98. So that would be open interest. That would contribute to open interest at $98 for that particular company. Okay, now why is this important? This is important because based off of how much open interest is at a particular price is what's going to determine how long that stock trades or fluctuates around that specific price. There's going to be a lot of activity or a lot of friction. That is what's going to drive where the price of the stock wants to go, because there are orders that have been placed that need to be filled. Okay, so with that being said, let's use $100, $99, and $98 as an example for company A. If you check the open interest, you might see there might be 2,000 open interest at $100. There might be 150 open interest at $99, and there might be 80 open interest at $98. Where do you think the price of company A is going to want to be at based off of the open interest, aka the orders that have been placed? Where do you think is going to drive the current market price? Yes, you guessed it, $100. It is going to drive itself to $100 because it's going to fill in the other orders, right? So it may dip down to $98, grab a hold of those, may dip down to $99 or come back up from $98 to grab those orders, and it's definitely going to touch $100. And it might stay there a little bit longer because there are a lot of orders. There are almost 2,000 orders at that price range that need to be filled. That is important. That is important because with that information, you can better understand why a stock is reacting the way that it's reacting. Now, I'm sure some of you may be asking, okay, so what exactly determines the open interest? Like, why are there 2,000 open interest at $100 for company A, but maybe 100 and something open interest at $99. There are many different reasons, and I can't answer all of those reasons because each investor or trader may have their own reasons. But some of the factors to keep in mind is that $100 is aesthetically pleasing. I know that sounds silly, but yes, because it's aesthetically pleasing, people are more likely to put in orders at that price than, let's say, $99 or $98, okay? Because it's more aesthetically pleasing. In better terms, it is a, how should I say this? It is a factor of 10, okay? Any price that's a factor of 10 is more likely to have an open interest than similar prices around that range. Okay. So with that being said, there's always going to be more resistance or more support at those ranges, at the $100 ranges, the $90 ranges, the $80 ranges, $70. You pretty much get it. Okay. Now, some other reasons why there might be a higher open interest at a particular price is based off of its history. Yes, you guessed it. If you look back at what this company A has been trading at, or how it's been trading around this price range to where it may have been around that price range in the past, you will notice that there's a lot of support, or maybe a little bit of support, and a lot of resistance, or maybe a little bit of resistance at particular prices. History repeats itself. And so if you noticed that there was a lot of resistance at the $100 price range, let's say it was there 3 months ago, and it's around the $100 price range now, if it got rejected, and by rejected I mean it failed to stay above $100 3 months ago, and it treated that $100 as a resistance zone, and it got rejected, we can anticipate similar activities when it's around that range again. Now, does that mean it's going to act exactly how it acted 3 months ago and completely come down and get rejected by $100? Not necessarily, but we can expect there to be a whole lot more price action around that range. And so we know if you are bullish about this company, before just hopping into it at $100 and riding the wave up, we can consider that there's going to be some kind of resistance there. And that doesn't always have to be the case, but we're going based off of what we've seen and what we've experienced, what we've observed, right? So with that being said, there are going to be a whole lot of orders, which is open interest at that $100 price range. With that being said, for the people observing this company A trading at around $100 in real time, most of you may be on the same page, to where most of you are bullish. Bullish meaning you believe that stock is going to go up, but at the same time, based off of how it's reacted in the past, there have already been orders placed to sell the company A, or to sell the shares of company A at $100. And so people are trying to maximize their gains. Let's say in the past, someone purchased company A at $50 a share, and they're looking for a good exit point. Placing it around $100 would be a good exit point, because they see that it has tested that range before in the past and it has failed to break it. So instead of taking a bigger risk to staying in and potentially riding that up to, let's just say, $200, they might say, well, you know what? I've seen it touch $100 before in the past, and I've seen it come back down. I don't want to lose my gains. And so I'm going to put in a limit order so that when it does touch $100, it's going to sell and I'm going to take my profits. Because remember, Just because you're up does not mean those are your gains. Until you sell it, until you sell the company, or until you sell the shares of that company, you have not made profit. You need to sell to either get a profit or a loss. You do not consider you being up or you being down in a position that you did not sell or that you're still hanging on to as profits and losses. That is not what we're going to do. Now, that is something to consider, right? So if you are bullish about this company, we can expect there to be resistance at $100. And it doesn't always have to be, but we're going, like I said, based off of what you've observed in the past. And you might actually not get so greedy, which would actually be a smart move, to put in a limit order to buy a little bit above that $100 price range. A zone that you haven't seen it touch before in the past. Because what that means is, if it does make it past $100, there's a higher chance that it's going to use that $100 mark. Instead of it being a resistance zone, that zone doesn't change. Instead of it being a resistance zone, it will now act as a support zone. So it broke that ceiling that has failed to break in the past. So what's going to happen is it's going to really push past it. And later on down the line, when it comes back down, you can expect more resistance at that zone, to where it's not just going to flush past $100 and go back to $50. It will get stuck because there will be a whole lot of open interest, a whole lot of orders around that $100 range, to where it's going to fill those orders and now gain more momentum to go even higher and head towards $150 or head towards $200. That is how it works, right? When a stock is going down, it doesn't just go down. And if it does, and it needs to go more down, it has to relieve pressure. And so what's going to happen is it's going to create what we call lower lows. Okay, because we all know stocks move like that. And it's the same. Stocks move like this in the down direction as well. Okay, so if a stock is plummeting down, a lot of people are visualizing this stock at a discounted range. They're going to get in. Not saying it's the best thing to get in, but people see different things. It's going to relieve pressure. Okay, it's going to get momentum, and it's going to come even more down. The same for when it goes up. So that's why it's very important to identify those support ranges and those resistance ranges. And one way to do that, aside from looking at its history and what it has done, is where the open interests lie. Right? So there are different features on whichever trading platform you're using where you could see where the open interest is. And you know the prices that have the highest open interest, there's going to be some kind of resistance there. Not saying that should necessarily deter you from making the moves you want to make, but it's definitely something to consider where you might see some friction. Okay, so open interest is very important when it comes to understanding where people have their orders placed. It's like an open book test. I know you guys remember those in school, those open book tests. This is the same thing. It's an open book test telling you where people have placed their orders. Now remember, these are limit orders, right? So we can't control what somebody decides to do at that moment, okay, which makes things a little less predictable, but at least you know and you have an idea of where orders are being placed, how people may feel, right? And how people feel are important because, right, hopping on the bandwagon, following the trend, following the patterns of what most of the traders are doing is what's going to help you capitalize and head towards the direction you want it to go. You just got to be smart. You got to think ahead and know when to exit, know when to beat the crowd. All right, guys, I hope you enjoyed this video. Make sure you subscribe, make sure you like, comment, share. See you on the next one.